Today, a year of contradictions. Hello again, it's Martin North from Digital Finance Analyst. It's our latest post covering finance and property news. Friday, Tarric is with me again. And Tarric, it's the final chat of the year.
Yeah, indeed it is, my friend. It's been quite a year and quite a bit different than what we were expecting. And, we didn't get the recession that a lot of people were talking about in the US. And, well, we're closing out the year on a very, very uncertain tone, aren't we? I mean, there's everything going on in the Red Sea with the Houthis attacking civilian shipping, and there's everything else going on in terms of, Trump not apparently, might not be on the ballot in Colorado. And wow, there's just, there's a lot to look forward to, isn't there?
Well, I called this show A Year of Contradictions because, there are so many things that have happened differently to what we thought they were going to happen, right? But also there are so many contradictions through the year. I mean, I'm thinking of Michelle Bullock's comment up in Hong Kong, that pretty much all households are absolutely fine, nothing to see here, right? And yet in their latest minutes from the RBA meeting, they were talking about households are actually under pressure. Another one would be the fact that interest rates had never risen so much in a year than we've had, and everyone's saying, well, we don't see anything wrong with that. There's nothing to see here. Almost wherever you look, you can sort of, hang on a moment, how are you trying to make this work against the narrative that actually has existed based on the data that we know? Another one, the ABS came out yesterday with their household wealth and said, oh, household wealth has gone significantly higher again, thanks to property prices. And of course, a lot of people were then writing, well, see, nothing to see here. Everything's fine. Wealth is growing. But of course, there's a distribution impact there. So it's like when you try and sort of stand back and just think about all the confusion and all the mixed signals and, are rates going up? Are they not going up? Almost wherever you look, there's confusion.
There is, but I mean, it's a little bit like, Schrödinger's cat. It's both alive and dead until you observe it. Although it's a little bit. I think with Australian households, there's actually a meme version that I think quite sums this up quite well. I'll see if I can find it and send it to you. But basically, it's a picture of a bunch of plates in a china cabinet that have all fallen up against the door. Now, the meme basically says that the plates are both broken and not broken at the same time because you know that you cannot open the door without everything just smashing to pieces on the floor. And in a lot of ways I feel like that's what's going on with households at the moment, and that's something, like as you said in the RBA minutes, they're basically saying, households have been pushed, a lot of households have been pushed absolutely to the wall. And then on the other hand, they're like, well, no, everything's going to be fine. Only a small number of households are going to find themselves cash flow negative, which I find is quite interesting considering the fact that they said it was going to be significantly more not that long ago. They were talking 14.6% of households cash flow 14.6% of mortgage holder households cash flow negative at a 3.6% cash rate. And today we're at 4.35. So yeah, I'm not so sure about that.
I love that you mentioned Schrödinger's cat. I actually almost called the show exactly that, right? Schrödinger's year, because that was exactly how I felt about it. And of course, the truth is, and the nice thing about the Schrödinger story is you don't know until you open the tin later whether the cat died or didn't die, right? So we won't know just how this year was until we actually get down the track and start seeing some of the data, into the middle of next year. And I think one of the other observations, Tarric, a lot of the information that's there is historical. So the ABS data was relating to wealth was the third quarter, not the fourth quarter. So a lot of the sandcastles that have been built in the air have been built on historical information rather than actually current information. And even the markets, the markets are now saying, oh, rates are coming down, at least 2 cuts in 2024. I'm thinking, yeah, I just wonder. So it's almost like we have no compass. Makes it very hard to really decode what's going on.
It does. And I think that part of the problem as well is that you have the data, but then you've also got the narratives. It's all well and good for people to be saying, "Oh, we're going to see six, 5, 6, 7 Fed cuts next year," but as a lot of notable individuals have quite accurately put out there, if you're going to see Fed cuts of that degree, it's because there's going to be a recession or there's going to be a severe downturn and a significant and a rather large uptick in the US unemployment rate. And it's the same thing here in Australia. It's all well and good to say, I mean, what was the CBA the other day? 1.5% of rate cuts over 2024, 2025. It's all well and good to say that we're going to see this magnitude of rate cuts, but unless there is a sort of catalyst to drive down inflation or some broad-based deflationary impulse across multiple categories of the CPI, that's only going to happen if you see, some relatively challenging times for the economy. And, well, I think that there's already some data pointing in that particular direction. Most importantly, things like youth unemployment, which, is a fairly solid leading indicator, or, uh, basically, snapshot in terms of where things are either at or where they are going in past economic cycles.
Yeah, I think you're right there. And, there are a couple other ones. So if I take my mortgage stress indicators, which are quite extreme, but it takes 2 or 3 years for that to work through to default levels going up, because people will hang on by their fingernails for quite some period of time. And again, I talked to the debt counselors I was doing a couple of days ago, and the debt counselors said to me, never seen it so busy as we are. We've got so many people wanting help to try and figure out what to do. And again, if they can get a good advice from debt counselors, they can sort of navigate the sort of the hurdles, which means that they don't necessarily fall over immediately. So it's an interesting time, isn't it? Anyway, but coming up to Christmas, and I suppose there will be quite a few households who will spend anyway. We're going to put more on credit cards, and we'll pick it up in the new year, just regardless. There are others who clearly are cutting back, and I noticed that some of the retail firms are already discounting now before Christmas in terms of the New Year sale. So, that's another signal that probably we should take account of.
Indeed, I was actually talking to someone at a postage and logistics company recently, and they were saying that Black Friday was absolutely huge. It was their biggest demand for freight yet, that they've ever had. But then that they also noted that the December numbers have been very, very weak, arguably as a result. So, I think that the mess that is the seasonality issues with the ABS retail sales and just retail measuring retail and in general is just going to continue, because the seasonality issue has not been fixed, and it's not going to be fixed anytime soon. So, in a lot of ways, it's going to be, probably March or April before we're starting to get a more accurate read on where the retail economy is at, where that particular aspect of the economy is going, because all of the data between sort of October and January is now going to be distorted to some degree by that change in seasonality.
Yeah, good point. Another example of information perhaps not being as pure as it should be is the unemployment data, right? So if you look at the latest unemployment, which was higher, but when you look at the sampling, and then when you look at some of the changes that they're making in terms of the census changes and how that flows in, I'm not even sure that's a really good data anchor either.
Well, others have made this point as well, and I'm not just just for the viewers, this isn't sort of a sort of tinfoil hat viewpoint. I'm talking about sort of like notable economists at major banks and major institutions saying that basically the ABS data is lagging some of the other indicators. Say, for example, the Roy Morgan data significantly more than it normally does, and it's also lagging the youth unemployment data more than it does, and the one that it has in say the last, let's call it the last 15 years or so, when the two have moved relatively strongly together. So it's an interesting one, because the risk with the Australian unemployment rate, more so than most other countries in the developed world, is that we are still going to be growing our labor force very, very rapidly relative to where it was before, prior to the pandemic. And for as long as that continues, if jobs growth stalls even at a reasonably decent rate, say 10 or 15,000 jobs a month, still creating jobs and probably enough jobs to keep things relatively static under more normal circumstances. But with the growth in the labor force the way it is, it's a pathway to a relatively swift rise in unemployment.
Absolutely. And in fact, I noticed that again in the minutes from the RBA, the question of the unemployment rate was something that they actually thought about, which I thought was an interesting observation, bearing in mind that Michelle Bullock previously had said that we need unemployment rates to rise.
Well, I think the real risk for the RBA is that things just get away from them quite quickly. It's all well and good for Bullock to come out and say that we need a 4.5% unemployment rate, which I think she's probably going to get. But it's the question of how swiftly we arrive there and the risk of overshooting that target potentially significantly. And I think that the RBA are in a really difficult position in that regard, because an absolutely key part of the calculation for where they think the labor market is going is how much the labor force is going to grow. Now, it's all well and good for the Albanese government to say we're cutting back on immigration, and Treasury says it's going to come down to 375,000 during 2023-2024, which is the current financial year. But what if they're wrong? What if they're wrong? What if they're, and especially, considering, it's a very, very complex issue and something that's very difficult to model, because it's all well and good for them to change all of these various settings in the migration system, but some of those settings are not going to apply to India because of the existing agreements between bilateral agreements between the Indian government and Australia. So trying to model how all this ends up washing out is very, very difficult. And Treasury has got as we know, has got the migration forecast badly wrong in the past. So if it does surprise to the upside again, even if it's nowhere near as large a surprise, maybe if it's 50, 60, 70,000, but that's still a significantly larger increase in the labor force than the RBA might have been expecting.
Yeah, well, I don't know what you think, but I think the MyEFO report that came out was sprinkled with a fair amount of fairy dust.
Yeah, I mean, but to be fair, that's not really all that uncommon. I mean, you look at a lot of these.
They have a truckload. They have a truckload of fairy dust available. Let's face it.
Oh, they've got it on demand. They've got a factory. They've got a whole supply chain. No, but I mean, the thing is, like, if you look at say, for example, you look at the migration forecasts at last year's mid-year budget, which was, this time last year, they were still talking about immigration at 240, I believe, it was 245,000, and it ended up coming in at 518,000, more than double. Now, they would have already had a fair idea of the visas being approved and all these other different things, and that, yet they still came in way, way off. And I just think it just goes to show, how challenging it is to forecast these things accurately for a start. And secondary, it's just a political mess on this particular front. So let me just put it that way, so I keep myself and you out of trouble.
Yeah, well, there are a few cross currents that, of course, are driving some of the decisions, and I think it's worth reminding everybody that the MyEFO is a political document, not an economic document. Yeah.
Well, I mean, I think the thing is that, for the longest time, it's all been about, positivity and, all the. I mean, just while we're on the MyEFO, I think it's just worth noting that the RBA is forecasting significantly higher inflation down the road than the MyEFO is for 2024, 2025. And I think I know why. I think it's because the RBA sees a significantly greater impact from the stage 3 tax cuts than Treasury does. That's my theory. I have no idea if it's true, but that seems to be, if you look at the RBA's forecast and you look how the modeling diverges and how the confidence intervals, which is basically the range of through which they believe that 95 or 75% of the outcomes will be in, expands around that time because of the uncertainty surrounding the impact of the stage 3 tax cuts. I think that just goes to show just how complex all this is, and just the different motivations and the different sort of viewpoints on that issue.
Yeah, very good point. And I will just make one other quick point, which, no surprise, but now the tax take is as high as it's pretty much ever been, thanks to the fact that the tax bands up to this point have been locked effectively. So the average Australian is paying more tax than previously, which is one of the reasons why, in fact, if you look at the relative growth of the tax take versus the impost of interest rates, in fact, the tax take growth has been a lot stronger than the interest rate uplift impost.
Yeah, pretty much. I mean, I just find that I find that quite amusing, to be completely honest with you, because there's all of this hand wringing and complaining and everything about the impact of rising interest rates. And I get that. I understand that. I understand that it's something that hits people a lot, but I think it's ironic that in pure dollar terms, the rising tax burden is hitting households harder. And that's just, yeah, it's just really something. Although it's, by the same token, this is Australia, so it's not really all that surprising.
Well, that takes us nicely into the first slide, which is, of course, the national debt problem, because the debt's a lot higher. And I guess we should probably move forward and talk about some of the slides and go on from there.
Yeah, sounds good. Well, as usual, folks, all the charts will be available at avidcom.substack.com. I've also got an article out today on the possibility of rates being cut in Australia, some of the historic settings, whether Australia's followed the Fed. If you would like to subscribe, both paid and free, that would be very much appreciated and would be a very nice Christmas gift for me and the family. So we will get straight into the slides without any further delay. Okay, now this is quite a big one, actually. What I've done here is I've taken all the RBA's data on rate rises going back to when their data starts, 1959, and how much mortgage interest repayments have risen across each of those cycles. Now, what I've done to make it fair is that I've taken the best possible proxy for what households are actually paying at the time across the entire period of the data, because obviously it used to be people just paid the benchmark variable rate and that was that. But then obviously the discount variable rate come in and all other various offers have come in, and that's obviously changed the average over time. So I've adapted to that over the course of this particular analysis. But suffice to say, the current interest rate rise cycle, which started in May 2022, has risen the average variable owner-occupier mortgage rate, and this is payable rate, not benchmark, by 126.9%, which is more than double the size of the previous cycle, which took place over a 6-year period between 2002 and 2008. Now, what I've done here as well is I've also done the math on the impact of rate cuts from the current cash rate. So if we were to see the RBA cut rates by 1.85%, which is sort of in the range of which some of the big banks are talking about, CBA's talking about 1.5%. So let's just say that. Let's just sort of overestimate a little bit from what they're talking about. That would take the cash rate to 2.5%, but mortgage interest repayments, I should say, would still be 62.2% higher than they were at the lows in 2022. So I just think it's really worth noting that compared with other cycles, rate cuts are not going to be the silver bullet for households that they once were.
Yeah, very interesting, Tarric. Of course, the starting point would have been those ultra low interest rates, which are artificially low, right? So that's the first point as to why the journey up is so much bigger. The other one, of course, that doesn't touch directly in your modeling is the average size of the mortgage. So if you think about the impost on households, there are two factors. The first is the interest rate being paid, but the other is the size of the mortgage. The average mortgage is much bigger than it was relative to income now. So if you actually also overlay that as well, then even if rates do come down like the CBA is suggesting, the size of the mortgage means we've still got a big problem for many households. So there's no get out of jail card available, even if rates drop quite significantly. And I still have a feeling that that drop is probably over forecast by the CBA relative to reality.
Well, I've looked at in the article, which I'll get you the link in the description. I went through all the various relative drops in mortgage rates that we've seen over time, and while it's true that we could see something like a 30% drop, 25 to 30% drop in mortgage rates, that's still going to leave mortgage rates significantly higher than where they were in 2022. So for a lot of people, they're still going to be in a very, very challenging position, particularly because inflation has eaten away so heavily at household budgets. And that's something that's really worth noting that hasn't really happened a lot in other cycles. And it's also the fact that in other cycles, you could sit back, you could hunker down, and your wages would, if this was like the 70s or the 80s, your wages would grow in nominal terms by 5, 6, 7% in a couple of years' time, and you could probably just about get out of jail free. We're not going to see that kind of wage growth here. It's just not going to happen.
No, I agree. And if you look at the early 2000s, the difference there was that wages was growing quite fast, so people were able to keep ahead of the curve. People aren't keeping ahead of the curve now. So if you're in the mortgage sector and you've got a big mortgage and you've got a significant impost now, that's going to continue over the next 2 or 3 years, which is one of my points I keep coming back to. The impact of high mortgages hangs around. Even if rates get cut later, it doesn't automatically get fixed. And I guess the other point there is if you're on the savings side of the equation, of course, savers are doing relatively well, although the banks haven't passed on the full amount of the rate rises to savers. And the ACCC report last week highlighted just how complex the savings landscape is with, I think the ABA said 900 different products available. Well, it tells you it's confusion deliberate. And that means that people are not getting the rates that they might expect to get. But also, if rates come down, then some of those savings income flows that have been quite strong will also get weaker. So, wherever you go, you can see how this this sort of journey back down to lower rates is going to have quite significant impacts on not just the mortgage holders, but more broadly too.
No, indeed, it's going to be a really sort of and I think that's something that's actually relatively poorly understood in terms of net how it all ends up working out. Because obviously some savers do quite well, while obviously mortgage holders are paying more. And I'd be very, very curious to see what the net flows actually look like, because I'm yet to see something that actually does, just net out exactly how it all ends up, coming out in the wash.
Yeah, well, exactly. And, that's what my model tries to do. It tries to look at it holistically and see how different sectors run. The other issue, of course, that rents are still bubbling higher at the moment, maybe not quite so fast, but still quite significantly higher. And if migration still is going to be strong next year, you'd expect that to put upward pressure on the demand for property, which potentially could also mean that inflation is higher than it might otherwise be. So it's a complicated puzzle.
Indeed, and that's something that we're going to touch on in a few slides' time. Now, there's an idea that basically the RBA needs inflation to be in or below its target band before it starts cutting rates. In terms of headline inflation, since the RBA cash rate era began and since the inflation explicit 2 to 3% target began, when it's engaged in a major cutting cycle, not just when it's already a cutting cycle's already began, but when it's started a cutting cycle, it's never actually been in the target band to begin with. So I think this just illustrates quite nicely that relative to the Fed and a lot of other central banks, the RBA is a lot more trigger happy with rate cuts than other central banks are. It's just, and that's something as well that the market and others have noted, that they are a lot more preoccupied with the labor market and the economy, see housing prices, than other central banks are.
Yeah, it's interesting. And partly that, of course, is because they do have this sort of slightly foggy multiple mandate. I mean, if you compare that with New Zealand, who's now got a very clear, it's about, steady inflation. That's the New Zealand target now, never mind what happens to unemployment and things like that. The second point is, of course, that, and Jerome Powell made this point the other day in his press conference, that as the inflation rate comes down a little, then the real interest rate effectively is higher than it might otherwise be, which means if you don't start cutting before inflation hits its target, then you're actually creating a bigger draft, as it were, or a bigger barrier in terms of the economy. So you almost would expect to see rate cuts start to come through before they hit the target band, which means they're trying to actually then predict how much trajectory or how much momentum there is in the cuts that they want to make versus the peaks of rates that they've already made hit the economy. And so trying to actually drive that, it's a bit like trying to land a moon lander on the moon from Earth, with a remote control. It's a bit dodgy. There's a delay, and you've got partial view of what's going on. So the chances of actually making it an immaculate soft landing is pretty risky and pretty low, I think.
Well, that's the problem for central banks now. It's just, I think Powell's commentary was unnecessary. I think it's pretty obvious to everyone, and everybody knows that the Fed will do what they need to do if things do start to go south. But as we'll get to later on in the slides, if things do reignite, particularly given the fact that they're running this enormous deficit that that outside of the pandemic and the war is just pretty much unheard of, that it could reignite inflationary pressures, and you throw in everything with the Red Sea, with the Panama Canal and everything else, and all of a sudden it's a possibility that you could just see a second round of strong inflation, and then Powell's credibility goes up in smoke. What little credibility he's managed to rebuild over the last couple of years.
It's interesting because Canada reported a peak up in inflation this last month, right? So it went in the wrong direction, and there are a number of cross currents, and of course base effects. In other words, what happened a year ago, as they drop out or don't drop out each month, will actually move the dial, not necessarily in one direct momentum. It'll go up, down a bit. And in fact, Macklem, who's runs the Bank of Canada, said, look, I expect inflation to be like this over the next 12 months or so. So it wasn't really suggesting that there was going to be a nice smooth landing. And the other point to Jerome Powell, of course, he was pretty dovish at the press conference on the day that they said no change in rates. But some of the other Fed leaders have actually since come out and said, we don't want to, overcook this. There's still a ways to go. So, yeah, you wonder whether, in fact, compared with where he'd been 2 weeks before, whether somebody from Washington had just picked up the phone and said, hey, just don't forget there's an election coming next year.
Yeah, there's quite a few people who've said that, Auntie Yellen might have twisted his arm. And, all I can say is, for a man who wanted to not be the second coming of Arthur Burns, who is now Arthur Burns, for those of you who may not know, was the 1970s era Fed chair, who is largely considered responsible for cutting rates too early and causing inflation to become embedded in the US economy. Powell did not want to be Arthur Burns, the second coming of Arthur Burns. This is something he has said, not so much publicly, but he has been said to people who have shared it with the press. And, for a man who wanted to be, the second coming of Paul Volcker, who was was basically the longer-term successor of Arthur Burns, who basically crushed inflation in the 80s with extremely high rates, and, well, someone who got a reputation for being, rather aggressive in pursuing that particular mandate, even though it did, damage to the US economy. He's pretty dovish, very dovish, in fact, for someone who wants to be Paul Volcker 2.0 and wants to have this great legacy of fighting inflation.
Yeah, and I've had the view for some time for that. At one stage, he did expect a recession. Magically, it didn't happen. So, they're trying to sort of recalibrate a little bit. But it is worth looking at the inflation numbers in some detail. And again, services inflation, a la connection to wages growth, is still quite sticky. And then, as you mentioned, we've got things like the the Suez Canal being pretty much shut off, so all the oil tankers have to go round, which has put upward pressure on oil prices, and if that continues, so I mean, there's a lot of uncertainty. But I was watching the Fed press conference, thinking, you don't need to say that. You don't need to say that.
No, he didn't. Okay, now people have asked, what does the historic setup look like in terms of how long does the RBA hold rates at their peak? The answer, about 10 months. So if we were to see the RBA cut rates when they traditionally do, based on the historical average, you're probably talking sometime around about September, sometime around about September next year. So it's going to be interesting because that's also when CBA has penciled in around about time CBA has penciled in the rate cuts for next year. So interesting times ahead.
Yeah, and just on that, the markets, of course, have got a bit ahead of themselves, probably talking maybe the first one could be March. Well, we'll see. I suspect it probably won't. Bearing in mind that the quarterly inflation isn't out till the end of January. And then there's a meeting in February, and then sort of later on. The periodicity of the meetings are a bit confusing in my mind now, but I guess we'll see. Yeah, I also note that CBA has tended to be more on the downside of rate moves right the way through this cycle relative to, say, ANZ or some of the others too. So there's diversity of opinion even amongst the bank economists.
Oh, 100%. I mean, I remember when, I think it was ANZ who was first broke ranks in terms of, calling for a higher than 2% cash rate. And, at that time, CBA was talking about 0.7, I think it was like 0.85 or 0.75 or something like that. And then CBA raised it to 1.5. And then all of a sudden ANZs were talking about pushing up towards 3. So yeah, they have lagged in that regard. So it's not really that surprising, although it's a bit tough to balance because on the other side of things, if the labour market does start to head south, what does the RBA do then? That is the real risk in all of this. If we see a swift acceleration in unemployment, say in the latter half of the first half of next year, that could really throw a spanner in the works in that regard. Because if unemployment rises, particularly if it's on a path towards rising significantly above where Bullock wants it to be, what do they do if inflation is still 3.5% or 4%, which is, possible?
Stagflation, here we come.
Yeah, quite possibly. And that's it before we even consider all the other stuff going on in the rest of the world, which we'll get to in just a few slides' time. Speaking of unemployment, this is of youth unemployment versus headline unemployment. Youth unemployment is there in the blue. And as you can see in past economic cycles, and particularly in the late 1970s and the 1980s, even as late as the very early 2000s there, you can see that it's actually been a bit of a forward-looking indicator, rising just a bit sooner than headline unemployment, somewhere between about 3 and 6 months, depending on the cycle in question. But as you can see there, it's actually seen quite a swift uptick in recent months. I believe it's risen by about 0.5% in the last 2 months alone, and by about 1% over about the last 5 months. So it's very much accelerated recently. So the risk now is that we see this particular weakness spread into the broader labour market, and that unemployment rises more quickly than the RBA might otherwise like.
Yeah, absolutely. And the hours worked, of course, was up a little bit, but nowhere near as strong as previously, which is maybe another indicator. I had a theory for some time that the growth in hours worked was partly driven by people grabbing more hours, more overtime, or more jobs to try and actually help get through this. But there's a limit to how much more people can work. And some of the other interesting observations that I'm seeing is that from my SME surveys, a lot of SMEs are talking about laying people off in the first quarter of next year, simply because of the fact that the economic momentum is not sufficiently strong for the building and construction sector, for example, and some of the tourism and some of the retail sectors. So I wouldn't be surprised to see more part-time jobs disappearing over the first quarter, which is perhaps another indicator of this idea of the unemployment worsening and spreading into other sectors of the economy.
Well, that's interesting that you say that, because I think that this cycle has been relatively unique. Because in past cycles, businesses have generally been more willing to shed staff than they have been during this one. And I think that that's because of the pandemic, because, you saw this sort of difficulty with getting staff during these periods of peak demand. And, not only that, but businesses have been conditioned as well to expect intervention, to expect the government to come back with the liquidity cannon and just to make everything hunky-dory again. So they've been a lot more reticent to cut staff. And this isn't just an Australian issue. It's been notable throughout the developed world. So I think it's just going to be interesting to see what happens if and when that sort of dam breaks and you see businesses go, you know what, things aren't improving. Things are going to be tough for a while longer to come. So we don't really have a choice than to start letting some people go. And as I mentioned previously, if we do continue to see that strong labor force growth, then that really could be a problem with unemployment. And as a little bit of a side note, that is something that we saw in 2008, 2009, where migration remained relatively strong, even though the economy was in a per capita recession and unemployment was rising.
Yeah, good point. And, there is some unique characteristics of this last 2 or 3 years. And so I was listening to a couple of commentators yesterday talking about the fact that we're still in the post-COVID era, because we had that massive government stimulus and we had that massive amount of savings are raising. The stimulus is sort of reversing. Interest rates were cut very deeply and now are recovering. So I'm not quite clear in my own mind as to whether we've really shaken that all off yet, or whether we've still got another year or 18 months of vagaries because of what happened then. Probably too much stimulus provided, too much liquidity, the money supply boosted too much. And by the way, the RBA is not going to be disposing of its bond holdings early, so they're going to sort of hold them to maturity, which means they don't have to worry about an adjustment to their value other than a mark-to-market value. But that means the money supply is still going to be quite above where it was previously for quite some time.
Yeah, it's going to be interesting to see how that plays out for Australia in particular, because you've got QT in the US, but the RBA generally focus quite heavily on short duration bonds. So that's going to be something that's going to be, as those bonds come due and as those bonds need to be rolled over by the federal government and by the state governments, that's quite a lot of debt that's going to have to be rolled over in a relatively short period of time. So that's going to be something that's going to be interesting over the next, 18 months, 2 years, as that debt does need to be rolled over. And not only that, but you are also continuing to see an explosion of debt at a state level. Alex Joyner had a nice graph out the other day that state debt's expected to continue to skyrocket over the next couple of years. So that's another thing that could put longer term upward pressure on yields and potentially keep that sort of, bit of upward pressure on mortgage rates.
Yeah, and just to add to that, the ABS in their report yesterday mentioned the term funding facility, a proportion of which has now had to be repaid by the banks. So they've dropped their balances sitting at the RBA earning up more than 4%. The term funding facility was cheap money that the Reserve Bank gave. But that means that the banks have had to actually go into the markets and effectively replace the term funding facility with higher cost bonds. So there is a risk that the margin compression that the banks are experiencing because of that switch means that they'll be less able to drop their mortgage rates, even if the RBA does cut the cash rate.
Exactly. 100%. That is really one of the big factors that we're going to see. I mean, and you've seen this with on the other side of the ledger with there've even been some financial institutions cutting deposit rates, even though broader, obviously, rates in the system are still rising, because obviously they've got they've got issues with margin compression. So it's going to be really, really interesting to see how all this is balanced out in terms of you've got, as you say, you've got all the banks searching for funding, and then you're going to have government and state governments searching for funding to roll over all these bonds. And I think that's going to be a very relatively unique situation here for Australia because we don't have the largest bond market in the world, and putting all that demand in over a relatively short period of time without having the RBA coming in and other entities coming in to buy up those bonds, well, things could get a little bit more interesting. So I think that's something that Australia is facing that's a little bit more unique than other countries who have more developed long-term bond markets. And say, for example, the Bank of Canada, they bought a lot of bonds, but a lot of those bonds were much, much longer duration than the short-term bonds that the RBA tended to heavily focus on.
Yeah, that's exactly right. It's a relatively small market, though some of the financial institutions are actually issuing bonds overseas rather than in Australia because of the small market. But that means you've got one exchange rate risk, but you've also got higher rates in those other markets too. So another reason why, as I say, I think that bank mortgage rates may be more sticky than people expect. And as you say, they've already started reducing their deposit rates, even at a time when rates are still very high. So folks, if you've got a term deposit that's rolling, it might be worth thinking about the fact that you might be at peak term deposit rates, at least in the short term.
Possibly. Okay, now, this chart makes me unhappy, but it is what it is. And basically what I've done here is calculated the required growth in net dwelling stock to keep up with the population growth predicted in the mid-year budget. And what I've taken for the domestic increase in population is the 5-year average. Now, it could come in below that, but I thought it would be better to sort of err on the side of a more average, nice little round figure. Now, I think it's worth noting here that there is a significant difference between the number of dwellings being completed and the number of dwellings actually being added to overall housing stock. Now, because of the impact of things like knockdown rebuilds, entire, sort of blocks of houses being knocked down to make way for apartments, townhouse complexes, etc., the one dwelling completion doesn't equal one house added in net terms. It's actually closer to about 0.85. So we don't need to build one house, we need to build about 1.17 houses, I believe was the figure. But suffice to say, we are not going to be building enough houses to keep up with population growth anytime soon. And that's sort of, even if we sort of see a decent recovery in the rate of construction, it's probably going to be sort of 2025 before we start to see a potentially significant increase in overall dwelling stock relative to demand. So basically, on these numbers, the problem is going to continue to get worse for several years to come.
And by the way, Tarric, it's not just Australia with that problem. I saw the figures from New Zealand. They've got exactly the same issue where their consents are actually falling. And in fact, there was a chart that they put in the Statement of Monetary Policy from New Zealand, which showed the sort of peak in migration as consents dropped, which just sort of says, see, that shows you those two things are actually, not correlated. They're actually going in two different directions, which creates potentially a bigger problem. And same in Australia with the the migration. So creating more demand, but we're not building more stuff. And the other point there is that the completion time, so how long it takes to start building through to it actually being available for occupation, is blown out, partly because of problems with builders and going out of business, partly because they're still getting flows slower than normal in terms of some of the parts to build. So there are many half-built properties at the moment that have yet to be completed.
Yeah, indeed, and that's all, and which is also adding to the demand for rentals. So
yep.
It's just it's a profound mess in that regard, and not to go off on too much of a rant here, but Okay, all right, I will. It's Christmas, why not? I'll treat myself. Okay, the problem is I read this stuff and say, oh well, it's just a catch up in migration. It's not so bad. Look at it, we're just a trend in terms of where the population growth would have been. But I've got to say, that's irrelevant, almost completely irrelevant. I mean, yes, from an academic perspective, very interesting. But in terms of the actual impact at the coalface for everyday Australians, it doesn't matter. What matters is the vacancy rate, is are we building enough homes? What is there enough rentals? What is the state of those rentals? How much are rents going up? How is that hitting the CPI? All those things matter. They matter to mortgage holders, even though there might be some mortgage holders out there who go, well, it's not my problem. Well, actually, it is. Because if we didn't have the rental crisis, rates would be getting cut a whole lot sooner than they otherwise would be. So everyone ends up paying for this in one way, shape, or form or another. So yeah, I really don't give a crap about the sort of, well, this is what trend says, because okay, like I said, it's very, very fascinating from an ivory tower overview perspective, but from a perspective of I care about the welfare of the Australian people, it doesn't really matter.
Oh, well said. Well, I'm going to just have my little bit of a rant here, because the other side of this is the quality of the construction that's actually currently in train, right? And if you look at Mascot Towers, for example, he's had a court hearing, and basically the judge said, well, they may have put your fees up. So this is effectively the strata fees, but you still got to go on paying them even if you're not living in the place. And there are examples where they've gone up from what, 2,000 a quarter to 8,000 a quarter. So people are actually going bankrupt. I was reading a white paper that New South Wales had put out recently about what's the problem in the certification in the construction sector, and basically there was problem after problem after problem being called out. From the fact that people weren't clear about what standards should be in place, through to the supervision of those standards, through to the ability to be able to monitor them and actually get stuff fixed. So the other point is, what's the quality? What's the quality of the stuff that's being built? And, with all this push to more high rise and, going up and adding more stories, the quality of those are just not up to it, in my view, largely. And that's going to, at least 50%, some would say up to 90% of properties being built at the moment have defects. So we're throwing stuff together, which is going to create another problem too. End of my rant.
No, the thing is, both our rants, are backed up by facts, by data. You look at, the New South Wales government commissioned a report into the level of defects in apartment complexes. I think it was a couple of years ago now, and they found that 40% had major defects.
Yeah.
I don't know about you, but if something has the word major defect on it, I don't really want to buy it. And not only that, but that's just the ones they've found.
Yeah.
You think about what some of these places are going to look like in 10 years, 15 years. And that's something that you and Edwin have covered brilliantly over the last couple of years, just how there's all these issues that are just sort of lurking below the surface. And, you can't help but wonder, like, where is the accountability at a societal level? It's all well and good to say, oh, we need to do this and we need to do that in terms of housing supply. But as you say, is the current housing supply that's being delivered adequate? Is it going to be adequate in 10 years or 20 years or 30 years' time? And is it even going to be there in that? Some of these, unfortunately, for some people, some of these houses and some of these apartment blocks, well, they're not going to be there in 30 years' time.
Yeah, absolutely. Well, Edwin has said quite consistently that some of them probably will need to be demolished. It's not a question of just retrofitting stuff if they're fundamentally, weak structures that actually can't be fixed. Then the only thing is to knock them down and build them again, which of course is a huge cost and environmental impact. And I worry with you as to what are the societal impacts? So, if you think about what poor quality housing does to a particular area over time, you can create ghettos and you can create, a spiraling down. I remember I was in New York years and years and years ago, and there were areas where similar things had happened. And, the whole tone of the area had dropped through the floor. And I'm worried that there'll be areas in and around some of our major cities ahead, which will actually be going backwards in terms of as a quality place to live. So it's a real issue.
Indeed. Sadly. Okay, now there's often a lot of talk about an exodus of investors from the property market, but I think this chart really just illustrates quite nicely that a mass exodus is very, very difficult. As of the end of the 2021 financial year, there were 3.25 million investment properties. Total housing turnover, as of the latest data from CoreLogic for the past 12 months, 479,000. If even a small percentage of investors, let's call it, say, 7% of people with 7% of investors, in addition to those who would normally sell in a normal year, decide to sell their properties. That's over 200,000 additional properties coming to market in a market that has less than 500,000 sales. Now, you don't need to be an economist. You just need to know what that would do to housing prices. And it's all well and good for people to say, well, what if all the investors leave? Well, if all the investors try to leave at the same time, housing prices will drop and the problem will solve itself. So, as Alan Kohler said on the ABC a few months ago, if they want to leave and they want to leave in droves, go for
it. Absolutely. And by the way, I will make this point. 3.25 or 3.3 million investment properties doesn't mean there's 3.3 million investors, right? If you look at the fact that there are still many, many property investors who have large portfolios of properties. And the distribution is actually quite interesting because there's quite a few people who just have one or two. But there are quite a few people who have 3, 4, 5, 6, 7, 8, 9, 10 or more. And that is also another observation when you actually think about the dynamic. In other words, what will property investors do? Maybe if they've got 14 properties, they might decide to dispose of one, but they probably won't dispose of 14. So there's a real set of inertia in this whole area. And by the way, property investors who held property for quite a long period of time and maybe have got a relatively small mortgage might be doing okay. But of course, the other factor is, in my surveys, I do see some recent property investors who've bought their first property, often a high-rise apartment, often not in a great location, often one that's got now this rising problem of strata fees. And so some of those are actually the ones more likely to sell, which means that when it comes to who might sell and what might be coming back on the market, we're starting to see now a rise of low-quality units for sale rather than houses. So in fact, if you look at the mix of houses versus units, it's sort of veering more towards units rather than houses. So whereas houses are in great short supply, one of the reasons why home prices for houses are still quite strong in many areas. So this is another dynamic that's really important to understand. It's the mix and what the investor portfolios are like as well.
Oh, I mean, the thing for me is that, you often hear about, the investor exodus, but there's no real evidence of it, in net terms. You look at, say, for example, people say, well, 30% of investors, in Sydney, in Melbourne are selling. Sorry, 30% of properties on sale are investor properties in Melbourne. It's like, yeah, but cool. 30% of over 30% of housing finance commitments are from investors anyway.
Yep.
So investors are selling to other investors in net terms. So basically, the point I'm trying to make here is not that investors are all going to exit the market. You look at New Zealand; they're not all exiting the market because they got rid of negative gearing. It didn't happen.
Yep.
The point that I'm trying to make is that investors may talk about leaving the market in droves, but the door's not big enough. And the reality is that we've seen very little evidence. There's an inclination for them to leave in large numbers. So, well, sorry, in larger numbers than you would see in a normal, sort of given cycle, after
Yeah.
accounting for demographics, of course.
Yeah, absolutely. Yeah. Well, we'll watch this space. I'm certainly, there's a few in my surveys who are considering it. There's also the fact that as people move into their later years, some of them are now reconstructing their portfolios and sort of down trading, downsizing, putting more money back into superannuation, all sorts of things like that. So there's another factor in the mix. So again, I think some granularity about who and when and what is pretty important, rather than just sort of a headline number on what property investors are or aren't doing.
Indeed. And just to sort of clarify just for a moment what I was saying. Now, if crap hits the fan and the economy has a recession, then obviously it's open season on this question. And that is one of the really big risks for the property market. Investors aren't going to leave in droves because of taxation changes, or because Dan Andrews did X, Y, or Z. Yes, some will leave, and there will be, and that will impact the market, but it's not this sort of let my people go, Charlton Heston parting the Red Sea sort of moment. For something like that to happen, you will need to see some sort of significant hit to the economy and to, the fortunes of, the property investors more broadly.
Yeah, very good point. Yep.
Okay. Now, speaking of the Red Sea and all of that we were talking about earlier, in some instances, the cost of freight from China to Europe has risen by about 300% since where it was last week, because of the fact that quite a few shipping companies, I would say at this point probably a majority of them by the size of the global fleet, have stopped traffic through the Red Sea and through the Suez Canal, and they're all sailing around the Cape of Good Hope, or around the bottom tip of Africa. Now, so far, this isn't a huge deal. It's entirely possible that this could turn into a giant nothing burger, but if it doesn't, if we do continue to see upward pressure on freight costs, and more importantly, the rise or resurgence in shortages, that could put upward pressure on inflation, because it's an issue of time. If you take, for example, one of the most popular shipping routes in the world is the route from Singapore, which is a massive trade hub for trade coming in from China, Japan, Korea, etc., into Europe. By forcing shipping to sail around the Cape of Good Hope, it takes an extra, the amount of time is increased by roughly 40%. So what you end up with relatively quickly is an issue with capacity of shipping, because now it takes so much longer. It takes so much more shipping to do the same job that you could have done before. So if this issue continues, and if the area does remain closed, it could be a fairly significant issue for inflation and economies more broadly. And I'll get to the other side of this particular issue in the next slide.
Right, and just a quick observation, of course, the inflation episode was partly driven by supply chain disruption, initially, right? That was what created it in the first place. And a lot of that was this issue of containers being out of position, ships being out of position, supply chains therefore taking longer. That means that stock was not available, et cetera, and prices went up as a result. So could be a replay. Depends on, as you say, whether it's a short or a long-term issue.
Exactly. And on the other side of the world, there are issues with the Panama Canal.
Yes.
Now, in a normal month, on average, there are about 1,031 transits. About 1,031 transits through the Panama Canal. And basically what's happening at the moment is that there is a drought in Panama. There hasn't been enough rainfall, and every time they open those big lock gates to let a ship through, a whole bunch of water from the artificial lake at the top that links, not artificial, but the lake at the top, I should say, that links the Atlantic and the Pacific, flows out into the ocean. And basically it needs to be deep enough. It needs to continue it needs to maintain a sufficient depth for ships to be able to pass through. And basically, they're concerned that by continuing to allow transits, that the level will drop, and basically you're not going to end up with getting larger shipping through. Now, the lowest level in recent years before this particular episode was 845 transits in June of 2020, which was due to the pandemic. Now, in November, that dropped to 783. And despite the fact that there has been some recent rainfall in Panama, which has improved the situation somewhat, that's going to drop to 720 in January. So based on an average month, that's 300 ships, over 300 that are going to have in January that are going to have to sail, or change their route, either sail around the bottom tip of South America or just change their route entirely. So if this particular issue continues, that in and of itself is going to put pressure on capacity for global shipping. And also, if this continues in conjunction with the issues in the Red Sea, then things get really challenging. Now, I think it's just worth noting that it could start pissing down with rain in Panama, and this could all turn into a giant nothing burger. And, somehow the Houthis stop shooting missiles at ships and, attacking them with drones or whatever it is that they're doing in this particular moment. But if it doesn't, then you've potentially got a catalyst for, at least some degree of additional upward pressure on inflation.
Right. And not every country will be equally impacted. I suppose it depends on where you import and what you import. And, I suppose routes from China down to Australia wouldn't be so impacted. But a lot of the stuff that Australians grab come from Europe and other places too. But of course, it's the knock-on effect, as you said. Price of shipping, it's a global problem. So in other words, whilst the disruption might not be complete, the price at which transactions take place could be significantly higher again, and that is another potential inflationary kick, which could be in the wrong direction.
Indeed, and it's also just the change in lead-in times as well. If ships if there's less capacity, ships get delayed, products get delayed. There are potentially shortages of certain items, and then, as we know, that puts upward pressure on prices. And I mean, you've even already got the likes of IKEA saying that there could be potential delays in products, and the issue is if that spreads to the broader corporate sector and broader supply chains.
Yeah, and we already saw an oil price move up as a result of this.
Yeah, exactly. So it's a real interesting sort of kettle of fish in that regard. Now, there's very much a mood of jubilation of we've beat inflation, things are going to be great, and the US is going to figure it out. Powell's going to pivot, and there's going to be a soft landing. And I think these two charts are quite interesting because they both point through independent, completely independent data sources, point to a reacceleration in US wages growth. One is from the Fed wage survey from all the various different regional feds, all fed into one system, and basically this is what it outputs, and also the NFIB small business survey of compensation for employees, both of which point to a reacceleration in wages growth. Now, the question is, one, are they right? And two, if this does occur, can US inflation be taken back to target in a swift manner? And I think that's a relatively difficult. I think that's a relatively challenging sort of prospect at that point, because if you have strong wages growth feeding into US rents, which are an enormous, and when I say rents, I mean both owner's equivalent rent and normal rent in the US CPI, which account for over 30% of the US CPI, that could make getting inflation back under control very, very challenging in the longer term. And it's just worth noting, just for fun, in Australia, rents make up less than 10% of the CPI because reasons.
Exactly. Yeah. Well, there are some certainly conflicting signals, and some of the feds are actually predicting quite strong growth rather than weaker growth, which means that the economic dial might actually be still not sort of slowing as fast as perhaps some were expecting. So this immaculate landing that everyone's sort of hanging on for is still it's another Schrödinger, isn't it, really?
Yeah, for the moment it certainly is. I mean, look, maybe they will pull it off, but I think that that sort of the market at the moment is pricing in this perfection, this Goldilocks situation whereby the Fed cuts rates 6 or 7 times, but there's no recession. And yeah, I'm not sure that Powell's going to cut rates 6 or 7 times if the economy is Goldilocks.
Exactly. Why would he?
Exactly. Why not keep the ammo for when you do have a problem?
Exactly. Yeah.
Uh, Speaking of the US, we have US housing stock on market, which is for the first time in at least the scope of this particular chart, rising unseasonably into the end of the year. And it's also worth noting that because existing home sales have fallen off, even though overall stock on market is still quite depressed, we're heading to not quite yet, but we're heading towards a greater equilibrium between the amount of stock on the market and the overall level of demand, as evidenced by the chart on the right, which is a longer term chart on the monthly supply of homes relative to the current level of sales. So if we do continue to see an acceleration in stock level and we do continue to see transaction levels remain depressed, well, we could see the US housing market start to turn in a little bit of a different direction. But, this is something that's a bit like a container ship. It's going to take a while.
Yeah, and of course, a lot of people have been not wanting to sell because the mortgage rates would have been a lot higher. So they sort of stuck in where they are, which is one of the reasons why the transaction volumes were down a little bit. So it'll be interesting to watch this. And of course, in Australia, the listings have dropped quite fast, in fact, faster than normal from low levels. But watch the US. I think there'll be some interesting signals in the first quarter as to how this plays out. So it's one to keep an eye on.
Indeed. And this is the last chart for the week. Oh, for the year, I should say. And basically, what we have here is an IMF estimate on the true scale of the Chinese budget deficit. Now, as you can see there on the top line, we've got the official deficit. Then you've got the actual government in terms of the central government's deficit once it's, sort of all been estimated out by the IMF. But once you factor in all the various other issues like local government and local government financing vehicles and all the other sort of extracurricular means that they use to sort of distort the amount of debt that's actually being taken on, the current level of the Chinese budget deficit isn't really that different to the federal deficits seen by the US during World War II, which is really something.
So what we're saying is that the official numbers don't necessarily represent the full story. There's a surprise.
In China, no way. No way, mate. No, never would have thought, eh?
Which sort of, brings us to the end of this conversation and to highlight, I guess, that this year has been a year of uncertainty and contradictions and all those things. But as we go into 2024, it looks to me it's going to be the same old, with more uncertainty with regard to the trajectory of inflation. The sleepers are what happens to China, clearly. Will the inflationary impulse re-emerge thanks to supply chain disruptions that we've touched on, or indeed because of wages growth? And meantime, will migration continue to bubble higher or go lower? And will we build any more houses? It feels as though next year could be as interesting as this past year has been.
Yeah, and I mean, in some ways, it's going to be a rerun of similar themes. Like, are the supply chain issues going to reignite? And I think also just, are we going to get the sort of recession and the economic downturn that was sort of postponed by these very, very unique settings that we've seen over the last, since the start of the pandemic, and also the changes in consumer psychology? And just because I promised, we've we've got the Santa hat going.
Very good.
Yeah.
Yeah. Well, those who are observant will notice that on the show as it's published, DFA up in the corner there is also wearing a Santa hat. So that's the best I could do, Tarric. I wasn't going to demean myself by wearing a hat, but well done for doing so.
Well, I'm a man of my word.
Well, I want to say thank you very much for all your conversations through this past year. It's certainly been a very eventful year, and for you as a family in particular, but more broadly for the economy. I've moved from Australia to the UK. We've certainly had a year of contradictions and uncertainties, and I look forward to picking up the conversation in the new year, and we'll try and make some more sense of stupidity, because there's a lot of stupidity about, isn't there?
Oh, I'm sure there'll be record amounts next year. No, it's been as always, mate. We've been doing this now for, well, quite a while actually. I think this has been coming up on 4 years. A full Olympics worth, and yeah, it's been great, and I'm looking forward to doing it all again in the new year, and just taking a moment to be very thankful for this opportunity provided by yourself and by the viewers who continue to tune in every fortnight. And, I just want to say, very Merry Christmas and Happy Holidays, and wish all of you folks all the best for the coming year.
Yeah, absolutely. Well, we couldn't have done it without the viewers and listeners. So thank you for all your support, all your questions, all your observations. Please like and share these. It's really important for both DFA and for Tarric to be able to do this stuff. And your support out there, we'll wish you a very, very happy Christmas and a very prosperous and effective new year. And Tarric, I hope you managed to get some sleep over the Christmas period, because I think you probably could do with some.
Yeah, hopefully Santa brings me some. That would be great.
Yeah, okay. Well, I wish you well, and we'll pick up in 2024. Take care. Have a good Christmas. Cheers.
You too, mate. Bye.